Hello, everyone. Thank you very much for being here. We're just so excited to have Brett with us today because he's just this amazing gentleman. I've got a great quote that will support what he's going to talk about today. So one of the things is I'm reading this. I told you about bottom line, and every once in a while I read you a little of an article, but there are so many articles in here that I've started reading that I think you ought to do some, maybe Google some of the different things that are upcoming that you need to know about. One of them is the tax laws. So Brett might talk to you about the sun is setting on certain tax laws. So if you're thinking about converting your IRA, traditional IRA or 401k into your Roth, the time to do it is now before the taxes go up because they are going up. So that's one of the things. Alternatives to traditional mortgage. There's many ways to do it. This article left out some really good ways to work with mortgages. And one of the ways to work with mortgages is to give them equity, do some cross collateralization and a few other things. So if you want to know more about how to be creative and getting a seller to carry back, give me a ring. Maybe I should set something up before that's a conversation. And then this one, I love this one because all of you who have financial advisors, Brett, who is a financial advisor, make sure your financial advisor is on your side. I'm reading a book right now called How to Smell a Rat. So in this article, he talks about what is really important. How do you do your research? So we have this wonderful gentleman, Brett, and I need to put my glasses on. I found this really great quote from Mother Teresa, and it is, life is an opportunity, benefit from it. Life is beauty, admire it. Life is a dream, realize it. Life is a challenge, meet it. Life is a duty, complete it. Life is a game, play it. Life is a promise, fulfill it. Life is sorrow, overcome it. Life is a song, sing it. Life is a struggle, accept it. Life is a tragedy, confront it. Life is an adventure, dare it. Life is luck, make it. Life is too precious, do not destroy it. Life is life, fight for it. And that is Mother Teresa. And the second one is by David Schwartz. I am going to live until I die. And I'm not going to get the two confused. I thought that was great. So today we have with us Brett Synicky, and he is a solo 401k consultant at a group called Sense Financial, with a professional journey spanning over 18 years in real estate investing. Brett is also a licensed California real estate agent. And his passion lies in empowering people to attain financial independence, affording them the possibility of an early retirement, which is why I read you these quotes, and an early retirement. And please join me in welcoming Brett, an advocate for financial success, which you know we are too. That's why we are the Nest Egg Builder. So Brett, welcome, welcome, welcome. We are so excited to have you here.
Yeah, thank you so much for the great intro. I really appreciate it. It's almost like I wrote it myself. It's really weird, but I appreciate that. And nevertheless, thanks for the opportunity. I love that quote by Mother Teresa. I haven't heard that one. I've read a lot of quotes in my life, and you wonder how much time did she actually spend putting that quote together? Because that's a lot in there, right? You could dissect every one of those statements quite a bit. So appreciate that. I have limited time, so without further ado, I'm going to jump right into my short but impactful presentation I've prepared for everybody today. So give me just one sec to work out the technicalities of this, and I want to make sure that I do it right. So I'm going to Okay, so give me like a thumbs up or something that you guys can see the screen before I go full screen. Yeah? Okay,
Yep.
cool. All
And
right.
your sidebar was showing. There you
Not
go.
anymore, right?
Right.
Okay,
Perfect.
perfect. Cool. All right. Well, yeah, we are going to talk today about how to use your IRA or 401k and or 401k to invest in real estate. And actually, there's a lot more you could do with it. We'll touch the wave tops on some of that, but we're going to primarily focus on real estate. So here at Sense Financial, our mission is actually to help people unlock their retirement accounts, take control of them, and protect them. And so people, our clients, they work hard for their money, and we want to come alongside them and work hard alongside them and help them be a fiduciary for their retirement accounts and grow it in the way that they see fit. And we have found no better vehicle than self-directing into a lot of times into alternative assets, right? So again, my name's Brett. My contact info is there. Please feel free to take a screenshot, reach out anytime. And just a little caveat, we're not a fiduciary. We don't provide legal, tax, investment, accounting, or other professional advice. If you need any such advice, be sure to reach out to your competent professional in that specific area. So you have two types of retirement accounts. You have conventional on the left, and that's the bus that's on the track that picks you up at a certain time, drops you off at a certain place in time. You have to walk to the stop, walk from it to your destination, and it really just goes a certain route and doesn't go anywhere else, right? That's your conventional. Think stocks, bonds, mutual funds, what the major firms offer, right? You have Vanguard, Schwab, Fidelity, all those household names, and they offer those types of accounts. We think of those as conventional. And then on the other side, you have self-directed accounts. So this is the off-road vehicle that can go where the bus goes or the train goes, maybe, but it can definitely go off the road, on the road, highways, byways, through mud, through some water, whatever else. That's the self-directed. You're unlocking the vehicle to be able to self-direct it and go where you want to go. So when it comes to alternative assets, you actually have a lot of opportunity. You have real estate, commercial, residential, tax deeds. You can become a private lender. You can become the bank, actually, and a lot of our clients love that option, whether it's syndication or just originating notes. They love to do that because of the passive nature of that. Many of our clients love to hold the hard asset of real estate, though that comes along with some white collar management duties. Even if you have a property manager, you're still dealing with tenants and toilets at the end of the day. So people love the passive nature of the private investing or private lending, rather. You can even invest in cryptocurrency, precious metals. There are virtually unlimited investment options. Most of our clients do want to invest in real estate in some way, shape, or form. And so the two products we offer, the two vehicles, on the left side there, you have the self-directed IRA. And the reason there's so many people of different backgrounds and male and female and all of the above is because you have anybody can qualify for a self-directed IRA. Okay. On the solo 401k side, which is the other product we offer, which I'll break down some of the benefits of each one of these. It's primarily for the self-employed, and it's for, hence the word solo, it's for the business owner and their spouse primarily. And we have both of those. Again, one just about anybody can qualify for, and the other one has that self-employment requirement with no full-time employees. And the IRA we offer is also known as a checkbook IRA or an IRA LLC. And this is, so to put this together, you have what's called an LLC that is actually designed to be owned by the IRA. This is a special purpose LLC, completely separate from any other entity you currently have. And you are the manager of that LLC, which gives you what is called checkbook control. So in every IRA, you have a custodian. Vanguard is a custodian. Okay, they're the custodian. When you buy and sell the assets that they offer, the stocks, bonds, mutual funds, and ETFs, you go through the custodian to make the investments and do those transactions. With checkbook control, you actually bypass the custodian. So you save time and fees and some headaches, because if you know what you're doing, and it's really not rocket science at the end of the day, depending on what you're investing in, then you can just do it yourself. You actually get a checking account and you have that checkbook control over I call it the home, 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 where the funds for the IRA are actually housed until you deploy them into whatever asset class that you wish to invest in. And so with this LLC, you get that checkbook control. So IRA LLC, checkbook IRA. There are companies that also do self-directed IRAs without the checkbook control. So you go through the custodian anytime you're doing transactions. And when it comes to owning an asset like real estate, where there can be multiple transactions, sometimes every month, going through the custodian each time for those transactions can become cumbersome. And depending on the fee schedule of that custodian, can actually add up to quite a bit of dollars each time. And so on the other side of the equation, you have the solo 401k. This is, again, it's designed for self-employed small business owners, been around since 2002. The IRA has been around, I think it's 1973, though don't quote me on that. I'd have to look it up, but it's much older. It's been around for a while. Nevertheless, we're going on 22, almost 23 years for the solo 401k. So it's very well established, and it's a traditional 401k plan covering the owner and their spouse. And the EGTRA law that came out in 2002 actually made many of the current benefits possible. So what is the eligibility? So I mentioned with the IRA, anybody can do it. With the solo 401k, you must have legitimate self-employment activity. This cannot be a hobby. If you want to know what a hobby is, just Google IRS hobby. They have a good article about it, but essentially it's something you do for fun. You're not really making money in it. It could be photography. It could be, I don't know, anything that you're doing, and you're not in business to make a profit. Although I will share with you, even if you're not self-employed, it's not hard to become self-employed. And as I go through this, I'm going to talk about the differences between the IRA and the 401k and why you might want to consider figuring out a way to get self-employed to qualify for the solo 401k if you're interested in self-directing your retirement. So some examples, many of our clients are doctors, attorneys, property managers, network marketing, flippers, wholesaler. I mean, the list goes on, right? You can drive for Uber one day a month and be self-employed and qualify for a solo 401k. And the other requirement is, in addition to the self-employment, is to have no full-time employees. And that's qualified as W-2 employees working less than 500 hours a year. So you can have independent contractors. You can have, the other caveat is they can be under 21 years of age and work full time, and you can still qualify for a solo 401k. But once they turn 21, or you hire somebody that's over 21 and they're W-2 and they're working more than 500 hours a year, which is about 10 hours a week, not much, then you're going to have to figure out what to do with your solo 401k. You're either going to roll it into a self-directed IRA, or you're going to roll it back into a traditional custodian like Vanguard. And those would essentially be your options at that point. Nevertheless, those are the requirements. So it's not hard to become self-employed, and you can have your W-2 job and still be self-employed. Many of our clients, like the doctor example here, the nurses, they have 9-to-5 jobs at a hospital, but they also moonlight on the side and do house calls or whatever it might be for that gets them some independent contractor 1099 type income. And one more note on that, you can actually be any type of business, sole proprietor or single member LLC, partnership. You can be incorporated, S Corp. It doesn't matter. All of the above will qualify as self-employment. So the benefits over and above the IRA with the 401k is the high contribution limits is one. So the IRA has an annual contribution limit of $7,000 if you're under 50, $8,000 if you're over 50 annually. Not a lot. And because of that, when people who aren't self-employed, don't want to get self-employed, don't have the capacity to do it, whatever the case may be, but they still want to self-direct, 99.9% of the clients that start a self-directed IRA transfer an existing IRA in because they've had time to build that IRA up. So they transfer $100,000, $200,000, $1 million, whatever it might be, so that they can self-direct. Again, this is designed to allow you to self-direct into alternative assets. So it's not like investing in the S&P 500 where you could do it probably for $500 or $1,000 minimum, depending on what firm you go to. If you're going to buy real estate or even do private lending, you're going to need at least $5,000 to $10,000 to get started with the private lending, and obviously more if you're going to hold actual real estate. And so 99% of the people transfer an existing qualified retirement account, whether it's a Roth IRA or a pre-tax IRA, into a self-directed IRA when they open a self-directed IRA. Not so with the 401k, because unlike the IRA, 8,000 max contribution, the Solo 401k has a max contribution limit of $76,500 annually. And that's actually broken up into two buckets. You have your employee contribution. So anybody that's listening to this that has a W-2 job or has in the past, you have your W-2 401k. This is the employee contribution you get up to $23,000 in 2024. And then if you're over 50, you have a catch-up contribution of $7,500. So $30,500 up to, if you're over 50, on the employee contribution side. And the benefit to the employee contribution is that you can put in 100% of what you paid yourself for your self-employment activity. So if you're a real estate agent and you have a 9 to 5 Monday through Friday, and you sell real estate on the weekends or nights, or maybe you just have it for that one deal a year that falls in your lap from a referral or a family member, and you make, let's call it $23,000 in commission, you could put that entire $23,000 in. Remember, you don't need this to live on because you have your 9 to 5 that you're living on. You can put that entire $23,000 into the 401k and self-direct it into whatever asset class you want. For the most part, I'll talk about a couple of the limitations that the IRS doesn't allow. But that's how the employee deferral side, that can either be a Roth contribution or a pre-tax contribution. If you're going to contribute to the 401k to a Roth, it must come from the employee deferral side. Now, the way you bridge the gap from employee to the 23 or the 30,500 to 76,500 is because on top of that employee side, you actually have the employer contribution. And so this is also known as profit sharing. This is a business expense for the business that sponsors the 401k. All right. And so you can contribute up to 25% of either the net income of the property, of the business rather, or the what you pay yourself. So if an easy example is, if you make $100,000 in your self-employment activity, you can contribute the $23,000 on the employee side, and you can contribute another 20 or 25% on the employer side. So for a total of 43 or 48,000. Now the difference between 20 and 25 has to do with either being a sole proprietor, single member LLC, basically unincorporated, that's 20%. If you're incorporated, S Corp as an example, then that's going to be 25% of what you pay yourself over the course of a year. Okay. And so that's how you get to the maximum amount. And please, by the way, put your questions, write them down, put them in the comments, whatever. We're definitely going to give time for questions at the end. We encourage that. The 401k has a Roth sub account built in. Okay. I mentioned that you can put into the Roth or pre-tax. That's built into the plan. Not so with the IRA. Every IRA is an individual retirement account. So you have either a traditional pre-tax or you have a Roth. You can do both, or you can do one or the other, but they're two separate accounts. Okay. So that's the difference. And the other benefit to the Solo 401k is that your spouse can actually participate in this as well. So all those numbers that I gave, if your spouse becomes part of the sponsoring business and she's doing some work for it and getting paid for that, you can double all of everything I'm talking about can be doubled. Okay. So you could put in potentially, if you're under 50, $46,000 as a married couple into your Roth 401k rather every year, which is massive compared to $7,000 annually in a Roth IRA, right? It is cost effective. It's much less costly to do because there's no LLC. We actually use a trust. And so as the trustee of the trust that the 401k owns, that's what gives you the checkbook control. So all the assets in the IRA are held in the name of the LLC, and all the assets for the 401k are held in the name of the trust. That includes the checking account. That includes any brokerage accounts you might open, or any property or any investments you make. Okay. and then they're easy to maintain. With the solo 401k, the only document that you must provide to the IRS annually is once you get over $250,000 of total plan assets, you are going to have to submit what's called a 5500 EZ, which we help with. It's 2 pages. It's really not hard, but essentially you're reporting the beginning of the year total plan asset amount at the end of the year. So if at the end of the year, December 31st, you have 250,000 or more, you're required to actually submit that form to the IRS. And it's, like I said, it's not difficult, and we actually help out with that. And Peggy was mentioning some laws that may be changing. I'm not aware of any on the horizon that may inhibit somebody from being able to do this. But one thing, and there might be, I'm just not aware of them. The one thing that is coming up, which is super cool, is that right now, as it stands, the IRS does not allow the government, whoever decides these kinds of things, does not allow for the Roth IRA to be transferred in or rolled over into a solo 401k. You can transfer, rollover actually, any qualified retirement account, former employer 401k, 403b, SEP IRA. It could be any type of retirement account except for a Roth IRA can be rolled over into the 401k. That's on the books. Actually, it's being discussed in Congress to actually change that, hopefully before 2024 is over, but I'm not holding my breath. Hopefully soon you can actually roll your Roth IRA into your solo 401k and self-direct it. You can roll a Roth 401k into your solo 401k. Now, 99.9% of the time, any 401ks or 403bs or any sort of company-sponsored retirement accounts must be from a former employer, okay? There are exceptions to that, but most of the time it must be a former employer. The other caveat to the Roth is that you can roll a Roth IRA. Actually, you don't roll it. It's a transfer because you're going from one IRA to another, one custodian to another custodian. You can roll your Roth IRA into a self-directed Roth IRA. Okay, you just can't go Roth IRA to solo 401k. So those are the options there. And the prohibited transactions, there's actually a couple things. Collectibles, so think stamps, baseball cards, that sort of thing. I think people abuse this and they bought maybe precious art and they were hanging it up in their, maybe a Van Gogh or something in their house, or some cars maybe. I don't know. You can't do collectibles, and for the IRA you can't also do life insurance. Okay, and the other thing is what can create a prohibited transaction is having the IRA involved with what's called a disqualified person. Disqualified people are a vertical line. Okay, your spouse. Okay, Bible says now you and your spouse are one when you get married, right? So you and your spouse, even though that's not vertical, you and your spouse, your parents, your grandparents, your children, their spouses are what are called disqualified people. What does that mean? Well, you cannot, as a disqualified person, benefit in any way from an asset that the IRA owns. So if you own a piece of real estate in Arizona, you cannot go stay in there. Okay, your daughter cannot go stay there if she's going to school in the area. You can't do that. They're disqualified. If you own an Airbnb in your retirement account, which you could do, then you can't stay there. Even if you stay there and pay full boat to the retirement account, what somebody normally would pay for the stay, you can't do it. Can't benefit in any way. The other requirement is a disqualified person cannot do any work on behalf of or, again, benefit from. So a good example is, as a licensed real estate agent, I can find a property because that's considered, so there's white collar work and blue collar work. The blue collar work is not allowed. The white collar work is okay. I can find a property. I can go search the MLS, or I can look up for sale by owners online. I can find a good deal, and I can potentially even negotiate a deal, but I can't use my license to represent the retirement account. I would have to, if I wanted a real estate agent to be involved in that transaction, it would have to be a third party, not a disqualified person that represents that. Even if I didn't take any commission, even if I gave it all back to the retirement account as a closing cost credit or whatever, I cannot do the work, that type of work on behalf of the IRA, because that would be actually working and benefiting from, because I'd probably get the commission for that. So that's kind of how the disqualified persons and prohibited transaction rules work. A lot of the questions we get are around that topic, as you can probably imagine. But just think about owning a car. We don't like to necessarily stop at that stop sign, especially if there's no one coming in the cross traffic. But generally speaking, we do follow the rules and we stop at the stop sign for one reason. Well, two reasons, really. We don't want to get a ticket. And the other one is we don't want to get in an accident. Even if we think no one's coming, people can come out of nowhere and you can crash, right? So it's the same thing. We still drive. We may not like the rules. We may not like the speed limit. And we probably break the speed limit every now and then, but don't break these rules with the prohibited transactions, because that can cause a lot of problems, especially in your IRA. Purchasing real estate. Again, you can hold real estate. All the income and gains generated by the Roth are tax-free. The income, there's no commingling, so income must go into and out of the checking account, and that's owned by either the IRA LLC or the Solo 401k trust. And you can actually use leverage. You can use non-recourse financing, which means the property is the only security for the loan, has to cash flow, and it's going to require you to put down probably 40 to 50%. But it needs cash flow and you need to have some reserves, but you can get a mortgage to buy more property if you so choose. And we do have a list of lenders who offer non-recourse financing on our website. If you need to access that, feel free to reach out and we'll provide that list or the link to that part of the website. And you can call those people and find out what terms they have. So, because they all offer something a little bit different. And one thing I will talk about, at the risk of opening up Pandora's box, with the IRA, when you have leveraged real estate, there will be a tax called the UBIT tax or UBIT. So when you have leveraged real estate, the income percentage of the leverage, right? So if you put down 50% and you have a 50% loan, 50% of the income is going to generate what's called UDFI, unrelated debt finance income. Okay, that is both the IRA and the 401k. Now, in the IRA only, that UDFI is going to trigger what's called UBIT or UBIT, which is unrelated business income tax. And so it's not as bad as it sounds. It scales up to 37%, but just know, this is a retirement account, right? This is either deferred tax pre-tax, or it's a Roth where on the distributions, there's no taxes, right? So it's one of those two things. So there are no write-offs when it comes to expenses on real estate. There's no depreciation. There's none of that. If you want to get that, and I encourage you to, own some real estate in your personal name, and you can take advantage of some of those and maybe potentially, turn your W-2 income into tax-free income if you have enough deductions and enough depreciation. But on the percentage of the income that is subject to UBIT in the IRA, you actually can take those deductions. You can do depreciation, okay? And if you're going to invest in a syndication, just make sure you fill out the W-9 correctly when you're doing that. We have instructions on our site for our clients. But if you need help with that, reach out, because when you do get that K-1, you want to make sure that it's not going to trigger UBIT, which, again, there is none in the Solo 401k on leveraged real estate, but in the IRA, you will have that if you don't do that correctly. And of course, with all of this, I encourage you to check with your tax professional or tax attorney to make sure that you're doing it correctly before you move forward with this stuff, as we do not play that role. And the only other thing I'll say on the Roth, if you can contribute to the Roth and invest in the Roth, do it. The sooner the better, obviously. Self-direct it, buy real estate, whatever. The question you have to ask yourself, because you can do Roth conversions, you can take pre-tax money and you can actually convert it into a Roth, right? That is a taxable event. So just understand that. If you do that, you're paying taxes on whatever amount you converted for that year. The question you have to ask yourself is, do I want to pay tax on the seed or do I want to pay tax on the harvest? And hopefully the harvest is much larger than the seed. So anyway, that's all I got. Let's open it up for questions, comments, whatever.
Great. Thank you very much for that great presentation. And I have a couple of questions. If you'd stop sharing so we can see everybody's hand.
I will do that. Yeah.
I know
Sorry,
David,
one sec.
I believe David's on here. He always has questions that I wasn't clear on something, so I want to bring up. You said you could convert your Roth to a 401k. Was that correct?
Roth 401k can go to a solo 401k.
Yes.
Roth IRA cannot.
A Roth cannot go to a solo. Okay,
A Roth
because that's
IRA cannot. Yeah.
pre-tax dollars, so that's where I was confused because I thought how are you going to do that? Because it's pre-tax, you already paid taxes on it, so it shouldn't be in a taxable event type. And then you also said about if you're an employee, you can make a $30,000 contribution. That's to your 401k, right?
Correct.
Is that company money or is that as your independent company? So if you're running, let's say, a Mary Kay, and you're making a bunch of money with Mary Kay, and you've got a full-time job, you could put all your Mary Kay money into this 401k, correct?
Correct. Now, there is a caveat to that. If you have a W-2 401k and you're contributing to that, the contribution, the 23,000 if you're under 50, 30,500 if you're over 50, that annual contribution is per person. So you can't double up on it. So if you're maxing out your W-2 401k, you can't also put in another 30,000 on your solo 401k. What you can do though is you can put in the employer contribution on the solo 401k. That's the 25% of what you pay yourself. And that can go from 0 to 69,000 or 0 to 76,500 if you make enough money, right? In your solo 401k. Does that make sense?
Not quite, because I'm not an employee. So if I'm working for a company and I can put 23,000 into my is that a 401? Then they're going to match that. And let's say they match it at 100. Well, they never match at 100%, but another 23,000. I could put that into something different. Is that what you're saying? Whatever they
potentially.
So let's say they do a 7% match or 10% match. I could do math on you. I'm putting 23,000 into my 401 into the 401, and then they're going to match 2,300 of that. You're telling me I could set that up in the solo 401k?
You could. Now, what I'm going to suggest is that you contribute to your employer 401k up to the match at the very minimum. And then if there's some left over after that, like let's say you get a match up to $15,000 and you're under 50, you can contribute another $8,000 if you want, right, to the 23,000. What you could do is you could stop that employer 401k at 15, and then you could contribute another 8 on your solo 401k from your personal self-employment business.
Now, could that go in as Roth?
Yes.
And then you just pay taxes on that 8,000.
Correct.
A lot of companies are now setting up 401 or setting up, I guess they're called 401 inside the company. They're setting up Roth. So you would be paying taxes on what you're receiving plus any match. Is my understanding.
I'm not sure on the match, but probably, yeah. I don't know about that. It's a good question. Definitely on the contribution, your contribution for sure.
For sure. Right. And I can put that in a Roth and I just pay taxes on it now.
Exactly.
So if you have a tax advisor, my suggestion is you call your tax advisor and ask, what is the benefit of using a 401 pre-tax dollars? Of how much deduction do you actually get? I've heard people come to me and say, oh, my advisor said that I should take the deduction. And I said, okay, how much is the deduction? Oh, I don't know. He didn't say. I said, well, find out. If it's $20, is it worth doing? Or if it's like $8,000, yeah, it'd be worth doing. But if it's only going to be 100 or 200, think about what you're going to have to pay after you have invested that money and now it's tripled or quadrupled. And now you're going to have to pay taxes on all of that.
Exactly.
That's my comments about it. So do any of you have, particularly you, Gary, any have questions or thoughts about putting your 76,500 away in a 401k where you have a check writing? If I understood that correctly, I could write checks against my 76,000, which I get to contribute every single year. But then all the money it earns is going to be taxable. Correct? Jonna,
Upon withdrawal, yeah.
upon withdrawal.
Right. If it's pre-tax. So, yeah.
Right. Yeah, Jonna.
Yeah, Brett, thank you. I've heard lots of presentations on self-directed, but you brought up some things that I didn't know, so kudos to
good.
you.
I'll take it.
Yeah.
Let's talk about, which I think is relevant to this group too, employment, the definition of employment. Does this need to be earned income? For example, if I'm a real estate investor and I am an active real estate investor and a passive real estate investor, can I have a solo 401k?
So glad you brought that up because I had a mental note to talk about that during my presentation and I didn't. So thank you. And many of the people that come to us are already real estate investors as well. And they have like maxed out their personal money and buying real estate. So now they hear about this self-directed idea and they find out they can own more real estate and own it within their retirement account and grow it tax-free or tax deferred, right? So when that happens, they could either do a self-directed IRA without any self-employment activity, right? They can stay a passive income investor, buy and hold, whatever. But when they hear about the solo 401k, oftentimes they're like, oh my gosh, the benefits are so good. I gotta start a business of some sort, right? I need to qualify for that solo 401k. So when people own real estate, and I think I'm answering your question, correct me if I'm not, but this is really important. Even if I'm not, this is really good, I promise. If people own real estate and they live off that income, or even if they don't live off that income and they're managing their rentals, it's very easy to form a property management company, especially if they're already doing that job. And then when they form that company, which is as simple, again, you can be sole proprietor, LLC, whatever, it doesn't matter, S Corp. Usually the easiest way, especially if you're in states like California where the LLC fee is $800 a year, it's easier to just do sole proprietor. And you don't necessarily need the protection of an LLC because you're just managing your own rentals and you hopefully have hazard insurance and umbrella policies and everything else that protects you. But nevertheless, start that property management company. You can do it in a week if you're doing sole proprietor or less. Come back to us. We can help you establish a solo 401k, and then you can qualify for the solo 401k. I feel like there's a part of your question I probably didn't answer, but that I definitely wanted to mention that part of it.
Well, that you're correct. So the property management's only one piece of owning property. You have investor relations, you have all kinds of other accounting activity, business activity, acquisitions. Are you saying you just need to form a company that is an investor relations company, an acquisitions company? If you're on I guess my question is, you have general partners and limited partners. Can all of the general partners consider this a business, self-employment, and create a solo 401k?
Gotcha. The answer is yes and no. And that's kind of a complicated situation because it depends on how much percentage owner you are and the other people are. And typically they have to be okay with you starting a solo 401k. So for example, if you had a multi-member LLC and there was like 6 people that were members of it, none of which are spouses of each other, right? You could potentially, one person could say, hey, I want to start a solo 401k. The other people have to be okay with it, and they can either participate in it or not participate in it. But it is possible to do that. So that does qualify. Now, the definition of legitimate self-employment activity has to be earned type income, right? So Schedule E income from rental real estate does not qualify you for legitimate self-employment activity. That's why we go the route of start a property management business. You could do an asset management type of thing, you know, whether it's real estate or not, and actually have a business about on that. But if it's passive income, Schedule E or whatever, I mean, you need some Schedule C income typically. Then you know, that's self-employment activity.
So if I'm putting a deal together, let's say John and I are find a property and we're the GP team, can't we each create our own business and our business comes in as the GP team, and therefore we can each have our own 401k?
It depends on the type of income. It depends on the type of income it is. That's most likely going to be passive income that you're going to want to pay the least amount of taxes on. And so it's not going to qualify you for, you know, solo 401k because you need that earned income. Now, to kind of hit on that same note.
Is it the GP team, the active part of the investment, whereas the LP is not?
Possibly. Yeah, we might be getting into territory I'm not 100% sure on.
Okay.
Probably I could ask Dimitri, the founder of our company, that question. I don't know. Yeah, I don't know. That's a good question, though. I appreciate it. Because now I'm going to find out. Yeah.
Yeah, and I think now that we're talking about it, it is a little bit of a can of worms because a lot of GPs aren't taking it as earned income; they're taking it as capital gains because it's a more favorable tax treatment, and they can,
Right.
you know, they can do 1031 exchanges, kick that can down the road. Right. So that's a balance between what you want to call earning, but yeah, there are fees. The GP does charge fees, right? So those would be earned income.
Yeah, so there's property management fees and there's also the assets under management fees.
And acquisition fees and disposition fees, because that's real work, right? Going to the closing table and stuff like that. So I mean, it's all real work, but
Now, bear in mind, when you have a 401k, you have to have the sponsoring business, right? So if something happens to that business, the 401k is no longer valid. And you can, you know, we can restate the 401k with a new sponsoring business. That's not a problem. But if you are no longer self-employed all of a sudden, like one of these GP examples that kind of comes and goes maybe in 5 or 6 years, potentially, that's going to potentially cause a little bit more work down the road for somebody. So that's something to bear in mind too.
so if I wanted to do investor relations, would I be better off setting up an investor relations firm and then having clients?
What do you
I
mean?
would say that's a yes, but yeah, that's a really good question for somebody, a tax professional that knows self-direct retirement accounts. But yeah,
Right.
I like the creativity.
Yeah, you can come in as a property manager.
Yeah.
You could be part of the GP team and you're the management company also. So you could have the management company and you're doing more deals and you're always the management company. So the management company doesn't go away just because you sell that property, for instance. You just lost your client. That's all. They sold the property and whoever's taking over the property is not hiring you, but you have other properties you're managing. So you have a company that's ongoing.
That's true.
Run that way. Not
correct. Yeah.
Right. It can't just run on this property and that's it. It could run on all your properties. So you keep looking. And that's why you hear people saying, oh, I got 1,000 doors. They've got 23 properties. Right.
Right.
And they have their AUM, assets under management fee. And then they also have they might have their management fee if they're doing the property management.
And then I wanted to clarify Peggy's question because you guys lost me. I wasn't sure the two of you were talking about the same thing. And this is, I can roll a Roth 401k into a solo 401k, but not a Roth IRA. Is that correct? So that is correct. I'd have to roll a Roth IRA into a self-directed IRA.
That's correct.
Okay, that makes sense. Okay.
But I can take my traditional and roll it into a 401.
That's correct.
because I could add more to it. Okay. And then you're not a custodian, but you oversee. You said you're not
Oh
a
yeah,
custodian?
let's talk about the role we play because sometimes
Yeah,
that's
let's
a little
talk
bit
about
confusing.
that. I think that's really important.
So we are for the 401k, we're the plan document provider, right? We put the plan together. So the easiest way to say this is that we provide the vehicle, whether it's the IRA or the 401k, that allows people to self-direct. And from an ongoing standpoint, we offer unlimited client support. We help people maintain their plans. And with the 401k, there's no custodian, right? So the person that is the client is the fiduciary, the trustee. Same with the IRA, but it's a little bit different because there is a custodian involved. And so we are not a custodian. There's a third party. We use SDIRA Bank out of Colorado, which a lot of self-directed companies use as the custodian. Most of the time, it makes sense to also have the checking account at SDIRA because they are a bank and they set it up correctly. However, it is possible to have them be the custodian and have the checking account be somewhere else. And we do have a couple of other banks that we work with on that, but SDIRA is currently the custodian for all IRAs. And so we put it together and we put the plans together and the documents and create the IRA and then help people get it all established. So we establish the LLC or the trust, we create it all and file everything appropriately. And then people can start self-directing. With the 401k, it only takes about 4 business days. With the IRA, it's about 2 to 4 weeks, somewhere around there.
So you're operating. So you were talking about somewhere I saw or heard you need to have an OA operating agreement. Right. But this is only 401. You don't do no Roth, correct? You guys don't handle any Roth at all?
No, we do. The Solo 401k comes with Roth built in. So if you want to make those contributions, Roth, you can. And then the IRA, it would be 2 separate, right? If you wanted a self-directed Roth IRA, that's one self-directed IRA. And then the pre-tax would be another one if you wanted to do both. You can do one or the other, or you can do both.
And you can in both of those, you can have your own checking account and do it all through checking.
Yep.
Okay. And so how do you guys make money?
Well, we have establishment fees. So for people that come, is it okay to tell the fees? Is that okay? You don't mind, right?
Okay with me.
Okay, cool. So for people that come from the nest egg builder, we knock off some because we appreciate the relationship and the referrals and such. But anybody that comes through this for the IRA, for the 401k, we normally charge $600. We'll do it for $500. That's a one-time fee, and that includes the first year annual maintenance fee, the trust, everything to get started. And then after that, we have a flat starting in year number 2, $250, and that's annual. And that's it. There's no other fees from us for doing that for the 401k. The IRA is a little bit different because you have the LLC cost. California's $800, so it's a little bit different. But suffice it to say, we normally charge $2,000 for the members of that come from Nest Egg Builder. We would knock off $200, so that would be $1,800. One-time establishment fee, first year custodian fee, and then again in year number 2 and annually from there on, it's $250 flat after that. And there is some flexibility on the IRA LLC because depending on what state you're in, it may not cost as much to set up because of the LLC fee. So,
but you have to do it as an LLC. You can't do it as a sole proprietor.
Well, I think you're confusing the sponsoring business of the 401k with the self-directed IRA. So to get checkbook control, yeah, that's okay. To get checkbook control, you have to have the LLC. Or the trust, which is for the 401k. So, yep.
Okay. Yeah. Well, yeah. California, 800, ridiculous 800. I've asked them to look into that. They just pretty much ignore that question.
Yeah. Now we can do an LLC in another state. Sorry to interrupt you, Peggy. So if you live in California, we set up a registered agent in whatever state you choose, and we could do the LLC there instead. So that is an option.
You have to be there also. Where's Solera?
Colorado. No, doesn't have to be.
They're in Colorado. Okay. Yeah. Yep. Just your money's working in, because I tell you, California wants their money and they're not nice about it. Ask
Yep.
me how I know.
The hard way.
They keep sending me documents. Okay.
Do any
Well,
of our
that's
visitors have any
great.
questions?
Yeah, Patricia, you have
Everyone's
any
quiet.
questions? Gary had to leave. He's pretty knowledgeable about a lot of things.
No, I don't at the time. No.
Okay. Oh, and
All right.
David left us too. Hi, Jay. You have any questions? Or Maria, do you have any questions about setting up a solo 401k or any questions regarding how to use it?
No,
Well,
Okay.
he may have addressed this, but from a corporate lens, and I am admittedly ignorant about 401ks as such, because from a corporate lens, there's negativity attached to it. So in today's alternative investing environment and kind of sophisticated investor perspective, what is the upside of having a 401k as opposed to any other type of structure to build one's assets? I get the transferability part of it, but why a 401k that, according to this particular structure, in contrast to any alternative? Because some people, like the general public, they're getting negative messages about 401k, and they put 401k into the category of 401k, and they don't have any point of reference as to what's good or bad about it.
Mm. Okay. Well, I mean, what I would say is this. You can actually self-direct any type of retirement account. You can self-direct an IRA. You can self-direct a solo 401k. You can even self-direct an HSA account, a health savings account. It's pretty wild what you can do. You can self-direct a SEP IRA, right? What we have discovered, and when Dimitri, our founder, was starting this, he started out with self-directed IRAs, and then he discovered the solo 401k. And we do both, of course. But the reason, if we could just do solo 401k, we would, because it's such a superior product. The problem is we would leave so much business on the table because you have to be self-employed to do it. That's why we also do the self-directed IRA. But the solo 401k is just such a superior product to anything else out there because of the annual contribution limits, the participant loan option we didn't even talk about. You can borrow up to $55,000 or up to $50,000 or 50% of the 401k balance, whichever is less, and use it for virtually any purpose, and then pay yourself back. And so that's there. We didn't even discuss that. The annual contribution limits are, again, up to 100% on the employer side, the employee side. And then you can do 20 or 25% of the employer side, up to 76,500 if you're over 50. 69,000 if you're under 50 for 2024. And yeah, and I see your question. Let me see. Thanks. Can those with a corporate 401k transition into solo? Okay. Yeah. So no worries. And please, I don't care if I talked about it already. I'm happy to answer any questions. You can, yes. Typically it has to be a former employer 401k to be able to transfer to another custodian. Now, this is the same as even if you don't want to self-direct, if you're tired of, the employer 401k using, I don't know, Fidelity, and you want to go to Vanguard because the fees are lower, you can't transfer that to Vanguard until you're a former employer with that employee. That's 99.9% of the time. So, and that's the same thing with the solo 401k, or going from 401k to self-directed IRA, because you can do that too. You can roll that 401k into, again, once it's a former employer 401k, into the self-directed IRA or into the solo 401k. So hopefully that answers your question.
So I can't
Please let me know if it doesn't.
So I can't roll my self-directed traditional into a 401k, the one that I've had for 30,
Yes, you can.
40 years, because none of
Yes, you
it
can.
from a former employer.
No, I was just addressing her specific question. You can roll over or transfer any qualified retirement account. The only exception is that Roth IRA can't go to the 401k. That's the only exception. And
Okay.
then when it comes to employer sponsored plans, it typically has to be a former employer plan. That's what I meant.
Okay, fine.
Yeah.
Okay. Gary,
Good
do you have
questions.
any questions? Otherwise, we're close to the top of the hour anyway. Actually, we are at the top of the hour. And this was an amazing, amazing presentation. I have to think about it because you gave us a lot of information. Thank you, Jay. Love your heart there. That was
Yeah,
terrific.
thanks, Jay.
And Brett, I hope you'll come back again and talk to us at some
I
point.
will. I'm happy to. I
Yeah,
appreciate the opportunity.
yeah, it's very interesting. You are the first person to ever come on and talk about Checkbook. So we've always wanted to know everything we could about Checkbook. And now I love it. This is great. So thank you very much for being here.
Absolutely. My pleasure.
Oh, I don't want to do that.